Adjusting entries. What is an adjusting entry? Adjusting entries are made in the general journal using the accrual basis of accounting to recognize revenues that have been earned but not recorded and expenses that have been incurred but not recorded. Instead of re-recording entries when the accounts involved need to be changed, a new journal entry is generated which displays an adjustment. Adjusting entries are important as they maintain the current financial situation of a business. Without recording accounts that show the period in which the company is receiving income or incurring expenses, the company will not be able to keep track of their finances within the period. This is also important as it aligns with the matching principle that expenses should be recorded in the same accounting period as revenue related to that expense. Accrued revenues occur when revenue is accrued in a specific accounting period. However, cash will not be received until a later period, thus requiring an adjustment. As we can see in the example of service revenue that in the first journal entry, even though the service hasn't been paid for yet, there is still recognition of this account, which is why service revenue is credited and accounts receivable is debited. Then in the latter journal entry, we are able to account for the debiting of cash when it has been paid in that period for the service performed previously, and further the crediting of accounts receivable. Accrued expenses undergo a similar process as an adjusting entry to the accrued revenue, in that the expense occurs in a specific accounting period but the cash is not credited until a later period. In this example, the salaries expense is debited first, as it must be accounted for, however the salaries payable is credited as this is what must be paid. The adjustment in the second journal entry then shows the debiting of salaries payable, as this is when the cash must be credited, because the payroll has been processed. Revenues are seen when the good or service is recognized in the specific period, however the good or service is recorded first as cash in the same period. Then subsequently, whenever the good or service is provided, it will be adjusted to show its completion. Subscription revenue shows us how during the period when revenue is received, cash is debited and unearned subscription revenue is credited. However, the second journal entry further helps us understand that we can recognize how the unearned subscription revenue account can increase through debit, but the subscription revenue must be credited. Deferred expenses are when the expense will be recognized when the good or service is purchased. The general rule is vital to understand when recording deferred expenses being when a company pays cash before it incurs an expense, the company should always increase an asset account for the amount paid. In a depreciation expense, the first equipment account is debited as an asset, then cash is subsequently credited. In a year's time, the equipment begins to depreciate, which is displayed to be over a 5-year period, shown through the debiting of the depreciation expense and further the credit account being accumulated depreciation, as this is only the first year of depreciation.